Hey there and welcome to our channel. In today's video, we'll be discussing UK could face banking crisis worse than 2008 feat if city fails to prepare for fossil fuel collapse, what it means for the Federal Reserve and the economy. We're excited to share our thoughts and insights with you, so let's get started. In today's video, we'll be discussing a new report that suggests the UK could face a banking crisis worse than the one in 2008 if the city fails to prepare for the potential collapse of the fossil fuel industry. The report, published by a collective of climate activist groups known as the One for One campaign, estimates that the UK could suffer 500,000 job losses and be forced to spend £674 billion of taxpayer money to rescue its banks and ensure financial stability. This is because new climate regulations will make it harder for carbon-intensive companies to sell their products, leading to a reduction in the value of carbon-heavy assets held by banks, insurers, and fund managers. Globally, the report estimates that banks would need a total of $4.9 trillion in international bailouts if fossil fuel assets collapsed in 2030, putting 13.6 million jobs at risk worldwide. The One for One campaign is calling for coordinated action from governments and financial regulators to address what it says are critical weaknesses in the banking and insurance sectors. By requiring banks and insurers to hold £1 worth of capital in reserve for every pound used to finance or insure fossil fuel projects. If we don't have rules in place to ensure fossil fuel financing is backed by adequate levels of capital, it will be impossible to transition to a low-carbon economy without triggering serious financial instability. Joshua Ryan Collins, an associate professor in economics and finance at the University College London's Institute for Innovation and Public Purpose, said, "Banks and insurers need to have buffers in place to absorb shocks arising from collapses in the value of oil, gas and coal assets as new regulation kicks in and demand falls as renewables scale up," he explained. Enhancing capital requirements for dirty assets should also encourage banks to shift their lending away from unsustainable activity, which in itself will reduce transition risk. The report's authors argue that without these rules in place, it will be impossible to transition to a low-carbon economy without triggering serious financial instability. So, it's important for the financial industry to start preparing for the potential consequences of the transition to a low-carbon economy and to take actions to reduce the risks associated with fossil fuel investments. Thanks for watching our video. We hope you enjoyed it and learned something new. If you liked it, please give it a thumbs up and consider subscribing to our channel for more content like this. Don't forget to leave a comment and let us know what you thought. Until next time, take care.